Hey, how's it going, guys? Beast back with Beast Move TV. I wanted the title of this video is going to be how to get entries and selling options and how to allocate your money properly with minimal risk. So we're talking about entries. I got Webull pulled up right now. Just just a stock that I would like to that I've been using. Not relatively a good idea, or just a stock that I like to do. To show. Okay. For entries, right? So when you're selling a covered call, you want to sell your covered call when it's green. So let's say right now you see that it's red, right? If we look at if we look at if we look at Webull as in general, it's kind of like below our SMA simple moving averages, but for selling options, we really don't really need to do too much technical analysis. I just like to use different tools and indicators like that. But so you want to do it on red days. So you see that when you want to sell covered call, you want to sell puts on red days, and you want to sell cover calls on green days so you can get better fills. And what do you mean by that, right? So like let's say if the stock normally trades at $10 and it goes to $9, right? It goes to $9. If it goes to $9, right? I could put a this will all move, right? So if we get a 30% delta, which is this one, which is 2 away from the strike price, if it moves to 9, that'll be 2 away. So it would be uh, this would be 1, 2. So it'd be 1, 2. So it'd be at $8. At $8, it will no, let's do this 850. Let's say if it moves down a dollar, right? It goes down to 850 and 30% delta is there. All right, so then you're gonna go down. So you're gonna be able to sell it at almost 750, this 30% deltas, and they're gonna be paying really good in hindsight. This is just in general. So you gotta see how you can get your entries better and and things like that. The same way for the cover call side for the call side. So let's say if the stock goes up to like 5-10%, let's say it goes up a dollar or two, that's the time to put cover calls in those areas, because then you're basically, if it normally trades around this $10 range, then you could put it higher than what it usually normally trades in, and then it could reconsolidate back to that $10, and then and then you could also make money on your cover call. So basically this is what's happening. The stock is going up. It's gonna go up, right? Up, 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 up. And this is the normal range where we normally trade. And it goes up past the normal range and it goes a little bit higher, right? So then we're gonna put our cover call, 30% delta, and then it's gonna go back to our normal range where it usually trades, was right here. So it goes back from here to there, and it goes back to there, and it goes back to where it consolidates. Now, but you basically put this cover call up here, and then it goes down and it starts printing more. So it has a better chance of printing. And that's how you get better fills and things like that. Now you could do the same thing in a more like bullish, I mean more of a bearish, if let's say, because we're doing cover calls, so this would be the top side, puts would be the bottom side of the stock. So let's say if we have cover calls, right? We're doing cover calls, boom. But we could put this, let's say if we know that it's normally in a range and you feel very confident, you could put this at a higher delta. But of course, you have to make sure that you're doing the correct your thesis and what you're thinking about the company, and how, once and you've been seeing a stock move the way it moves for a while, you kind of understand the range it kind of sticks through. And then, of course, those couple of weeks or a couple of days that it breaks through, and it breaks through those ranges and creates all-time highs for that company or all-time lows for that company. But what you could do is, let's say if it shoots up, right? It shoots up, and then you could put cover calls directly where you kind of are, because you know that it's going to move back and consolidate. You could put it not where it's already, like where it's at, but you could put it at a higher delta, giving yourself a higher premium, and then getting more profits. Same thing on the bottom side. Let's say if it goes down, let's say this is a stock where it goes beep, 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 and then it goes down 5-10%, or maybe even 15-20%. Then you sell your puts goes, and then normally when a stock goes down 20%, if it has a good thesis and it's a good company, has good management motives, and it's a good company, then it should consolidate back to the upside and go and get leverage back up, and then you'll start printing from there up. So yes, so that's one of the things I wanted to talk about, was to get better entries in puts and in selling calls, and as well as this, guys. You have to be very careful. So let's say if you're first starting out and you want to put your puts in, you want to put your puts, or you're putting your calls or whatever, you have to make sure that you are not allocating all that money in the same time period. And what do you mean by that? Sammy. So you're like, okay, why what are you trying to say by that? So let's say if you put puts for let's say you put puts for the 36, right? Right? For 36 days out, so the 12th of December. So bam, you got puts, right? You got puts at a 30% delta. Bam, you got these, correct? You got these $9 puts for Weeble. So then you have those, correct? Then you don't have to, when you have a large enough account. This is not financial advice, by the way, guys. I just want to let this clear. But this is just one friend talking to another friend. Um, so like, let's say if you have the 9 strike price, correct? You don't want to put all your money on the 9 strike price, or all your things at a 9 strike price, because the problem is, if that does happen, if it does occur, then you have a thing that happens. So like, let's say if you have a 9 strike price and it goes past that 9 strike price, and you put all your money in that 9 strike price, you still have 36 days. But if you divide your money into different strike prices, so like, let's say if you have a 9, but let's say 2 weeks later it goes down 15%, and then you put it at 8, you see you have more strike prices to work with. And that's what you need to do when you have a large sum of money that you're trying to invest, and trying to get better entries into a position. Because then what will happen is then casually, over and over, you're gonna be better at doing this. And what's gonna happen is that you're gonna have some money that's gonna be, because at the end of the day, what's happening is we're having money work for us. And due to an option, that we basically placing an agreement of a contract that it won't go underneath this certain amount. But what happens is you could put some money in a certain time frame, and then wait a little bit, for a little bit of time, and then put another at another time. So like, let's say we wait for 2 weeks to pass by, and we do the 16th of January. You see, and then you have better. Then, if let's say if a stock goes down 15-20% on you, then it's better for you to try to roll or move around those dates, and play the stock, and play the option better. And that's one of the things that I wanted to talk about in this video, was for better entries, and to how to reallocate your money in different strike prices, and also different time periods that benefit you in the market. Because at the end of the day, what we try to do as option sellers is we try to just be right. I just want to be right for a certain, like, I don't have to be right all the time. I just want to be right for a couple of times. And let's say if I am wrong, I want to make sure that I have plenty of time to be right. And that's the game. That's honestly the game. And if you have multiple time periods of trying to be right, then you have multiple chances and it increases your chances of being right and creating profit. And that's the essence of this video, is what I wanted to talk about was better entries. So this is gonna be a review, guys. So if the stock goes up, that's when we want to sell cover calls. And if the stock goes down, that's when we want to sell puts to get into better entries and better fills. And basically lower our chances, because if we know that it consolidates at a certain level, then we know that it's gonna go back to where it consolidates. And then it could be there for a while, and we print on our option going back to where it goes, where it consolidates to. And that's the essence of this video that I wanted to just talk about today, as well as always have extra money on the side. So don't invest and this is not financial advice, but don't invest all your money at the same time. Always make sure that you have a backup, just think of your money as troops. I mean, yeah, think of your money as troops. And when you go to war, you don't want to set all your soldiers to war. Because what happens is, if let's say that your soldiers don't survive the war, you don't want that. The time to make money is not, you can make unlimited amount of money, but your capital is not limited. So your job as a trader is to protect your capital. And if you don't have supplies of army, like if you don't have an army supply, like on the side set for a rainy day, then sometimes it could hinder your success for war. And that's the essence of this video, guys. Thank you so much for watching. If you would like, I have a Discord to please join if you like, or please subscribe to the video as well, like and comment, as well as follow me on Instagram. And thank you guys for watching this video. You guys have a wonderful day. Bye-bye.